It is my absolute pleasure to introduce our lunchtime keynote speaker, Marisa Drew, who is not only a Wharton graduate, but also the Chief Sustainability Officer and Global Head of Sustainability Strategy, Advisory, and Finance at Credit Suisse. Marisa Drew is responsible for setting the sustainable strategy and ambition for the bank and for creating and facilitating sustainable investments on behalf of Credit Suisse's wealth management, institutional, and corporate clients. She has been with Credit Suisse for 18 years and in the investment banking industry for more than 30 years. Prior to this, she was the co-head of the Investment Banking and Capital Markets Division, Europe, Middle East, and Africa. Marisa serves on the advisory boards of numerous leadership, sustainability, and civil society organizations, including the Aspen Institute UK, the Milken Institute Center for Strategic Philanthropy, the FCA's Markets Practitioners Panel, and is co-chair of the HLG for Humanitarian Aid and the Oceans Panel. Her external activities also include serving on the Europe, Middle East, and Africa advisory boards of the Wharton School and the charity Room to Read. It is my great pleasure to have Marisa here with us today, and I'm going to be advancing slides on her behalf, so I'm just going to share my screen right now. Can you see my screen? Yes, wonderful. All right, I'm going to mute myself.
Terrific. Well, thank you very much, Sarah, and a real pleasure to be here. Always very happy to be doing something for my alma mater, of which I'm very fond. So I think the title of the conference, speaking of risk and opportunities, is exactly the way I think about the whole sustainable finance arena. If we flip to the first slide, I often like to use these two quotes, if you move to the next slide, which really do typify the way we look at the world. On the one hand, we have the quote from the great Al Gore, who was very prominent at COP26, who speaks about the opportunity set by saying that improving the quality of life without borrowing from the future is the single largest investment opportunity in history. It's got the magnitude of the Industrial Revolution, but as we all know, it's moving at the speed of digital. And that's exactly what I see in my day-to-day world. Everything sustainable is accelerating at an accelerating pace. And then on the other hand, you have Mark Carney, a man ahead of his time when he was at the governor of the Bank of England, really speaking to risks, essentially saying whether it's physical risk or effects of climate change in other ways, we really do have to rethink the value of all of our assets. It's affecting every financial asset that we have and that we hold. And that if you ignore that, you do so at your own peril. So always two sides of the coin when we think about this from an investment point of view. And I know earlier today you were involved in sessions that were somewhat macro in nature or very specific in nature of subsets of the sustainable world, whether it be insurance or otherwise. And I want to take us back maybe more at a macro level to think about what is it that we're all striving for when we think about mitigation of climate change. So if we move to the next slide, I think it's expressed probably most acutely in a report that came out just a couple of weeks ahead of COP26, and that is the IPCC report. So for those of you who are not familiar with what that is, this Intergovernmental Panel on Climate Change essentially asks hundreds of scientists to run their own models and have their own predictions of the trajectory of where the world is headed from a warming point of view. And then there's an independent panel made up of several experts that are global in nature, that are not biased and trying to get a consensus view. So they'll throw out the tails and come to some sort of a consensus. And if you look at this graph on the left-hand side, the green line, the very sharp green line, is the trajectory that would occur if we did nothing more to try to mitigate climate change than what we're doing today. The third line down, which is this sort of other green line, is pretty much where consensus is post-COP, that we're sort of headed more or less to a 2.4 or 2.7 degree warming in the next 50 some odd years plus, give or take. What we were really striving for, and what COP26 and the previous COPs were all about, was trying to mitigate and keep our world at 1.5 degrees. And I think all of us are acutely aware, and increasingly more so, of if we do not, what are the effects on all of us? It will be the proliferation of wildfires and droughts and storm activity and so on. And it will get ever more present in our lives. You know, we're sitting here sort of on at Wharton, and those of you who are physically there are sitting, with coastal, proximity. And I have a home in Connecticut that is hanging out over the water. And I can certainly tell you that when we have 2 once-in-a-100-year storms that come within 2 years, it really does, I think, bring it home and really create this call to action. So if we go to the next slide, maybe we can just make this even more tangible. So if we were to stay at 1.5 degrees Celsius, what it would require is that global emissions annually would have to be reduced by roughly 10%. And as much as I am an eternal optimist, I'm also a pragmatist and believe that that's really hard. That means we're going to have to take out 400 billion tons of carbon emissions out of the atmosphere in very short order. And, unfortunately, for all the good things that we're doing around the world, what we do find is, particularly with developing economies, and two of the biggest ones being China and India, they're certainly going the other way. And it isn't for us to judge, to say that they are bad and we're great in the West, but we have to recognize that they have developing economies, and those economies have needs. And as you have more and more people move into middle class or into cities, as they develop, carbon emissions come with it, because we are still reliant on fossil fuels. So if you look at this bottom chart, try to contextualize what 2 or a little over 2C means for us. So today we're at that sort of 1.5 degree increase, and we now have storm activity that's roughly 5 times what it was previously. If we end up in a 2 or 2 North Sea environment, which is really where we're headed, we will see these sorts of acute activities facing us about 14 more times than we see today. And if you move all the way over to 4C, it really is an uninhabitable world, roughly 40 times. So it pretty much means that that will be a normal way of life. And the world is not equipped to deal with 4C in any case. So this is why this is so very critical for all of us. And if we move to the next slide, what does give me hope and optimism is that there was a global call to action as we moved ahead of COP. COP, essentially, what it was intended to be was a convening of policymakers previously. And why this COP was different is you finally had the private sector show up in force. So both leading up to, during, and since COP, you've had the world's leading companies pledge that they will reach net zero by 2050. And most have also said that they will create interim targets and report on those targets by 2030. What is also increasingly becoming a best-in-class way of getting to net zero is to use an organization called Science-Based Targets, or for short, SBTI. And so this is essentially a third-party nonprofit organization that helps you set your trajectories, and they will be different depending on the organization that you are. And then they will be the ones to approve your trajectories and then hold you to account. So at Credit Suisse, with my CSO hat on, I did press our organization to adopt science-based targets. I must say it's a bit of an uncomfortable place to be, to put yourself in the hands of a third party that's going to hold you to account. But I felt that indicated a statement of intent and will. And I felt that was helping us, if we had that third party checking us, to make sure that we got there on a timely basis. And we'll come into that in a little more detail, because this is a really, really tough thing to execute. It sounds easy to create a pledge on the surface, but actually operationalizing this is pretty complex. And every one of these companies that's committed is having to do it in their own ways, and the roadmap has not been written. So in many cases, we're all trying to figure it out as we go along. So this is the corporate space. And if we move to the next slide, we can see what the financial services response has been to net zero as well. So what was created, which I think was a really interesting way of trying to galvanize the financial services industry, was to create a series of coalitions. And you see here at the bottom, there was the Net Zero Banking Alliance, which is what Credit Suisse joined. You have a version of this for asset managers. You have a version of this for the insurance industry, and so on. And what the intent was here was to take these subsets of financial services and say, instead of us operating in silos, if we can come together as a subset, or indeed as financial services broadly defined, and turn our attention. It can be our convening power, the power of our balance sheet. It can be even our ability to levy against policymaking. Then we can really use the power of what we've got, which is capital, to try to drive changes in accelerating pace. So leading it and through COP, Mark Carney was very, very proud to say that he was able to bring together about 130 trillion of AUM committed to net zero. That's a pretty serious endeavor if we think about that contextually in terms of the size of global capital flows on an annual basis. So that does give me hope, because I think if we can get capital to where it's needed to try to drive change in a very serious and rigorous way, we've got a fighting chance to get there. So if we move to the next slide. I also thought I would share with you some of the pledges and the outcomes of COP that struck me as probably the most meaningful ones. And the first and foremost was a pact, a coalition of 40 countries that have committed to basically eliminate coal. And coal is certainly a fuel that shouldn't, in the intermediate period, if not the more immediate period, really it doesn't have a reason to exist. And why do I say that? Is because a real green solution, a credible and cost-effective green solution does exist today. And we can, if we move quickly to remove ourselves from coal and adopt the greener solution, that will have a material effect on carbon emissions. Easier said than done, and certainly what was missing in the coal commitments was the presence of India and China and the US. But behind the scenes, what you did have going on were lots of discussions about a gradual timetable for reduction in coal, even in these other countries. The other biggie was a methane moment. One of the things that happens sometimes in these, I'd say, global movements is that there's a headline focus on one topic and one topic only. And sometimes that somehow undersells areas that we also have to make sure that we're on top of, and methane is one of them. So there was a big pact, 90 countries joining together to reduce methane emissions, and 30% is not inconsequential. Methane is largely coming from our agricultural practices and livestock practices, but it also comes from our factories. So there's many interventions to reduce methane, but it's also part and parcel to mitigating climate change. In addition, carbon markets. This is a big one. One of the things that we were hopeful for was a global agreement on a price for carbon, with the idea being that if we can actually adequately and accurately price in the negative effects and the negative behaviors, which of course is translated into carbon emissions, then all of a sudden what will happen is capital is efficient. It flows to places where it's going to generate the best returns. And if we are adding a price or a tax, if you will, on the highest carbon emitters, almost by definition, the capital will start moving to greener solutions. We didn't get all the way there. It's extremely complicated. You have lots of issues that you've got to deal with. There are discrepancies and inequities between developed markets and developing markets is one big hotspot. But also, even if you think about trying to price carbon across borders, so it's not just developed and developing markets. It could be from one country to another, even in the European time zone, for instance. How do you price if something is produced somewhere and you are consuming it across another border? So these sorts of concepts of carbon border taxes and credits are a hot debate because we don't have a harmonious market in total. But what did come out was an agreement to create a framework so that we can have a carbon trading market to try to create those efficiencies and let the capital markets be efficient and do what they do best. So that was a bright spot. And then in a couple of other hard to abate sectors, agreement in aviation and shipping. Aviation in particular is one of the hardest to abate sectors. Today, there is no green aviation fuel per se that is anything that is commercially viable, although we had one of the first test cases of an airline running on a green fuel, and they've proved that you can do it. This is a passenger flight. So my belief is that in fairly short order, there are some great minds, incredible innovation happening where we'll ultimately get to a green opportunity for aviation, but we're not there today. But there is certainly a will by the Pact for aviation reduction. And then if we move down to life on land, the big one for me, and honestly the surprise for me, was deforestation. Obviously, what we see going on in the Amazon is heart-wrenching when you see how much of the world's rainforests are being cut down for mostly agricultural livestock. There is a pledge to end. And what is interesting about this, it's a cross-country coalition. And what they've said underneath the big headline commitment is that they are going to take funds and they're going to pool them together to try to police the bad actors. Because one of the biggest issues in deforestation is you might be doing everything right in your patch of land, but if someone next door is a bad actor and you have no control by virtue of not owning that land, you still end up in the same problem and the same issue. So what they're talking about is using some of this very advanced technology, geosatellite, spatial technology, to actually track what's really going on in some of the remote areas and come together and try to police that. And that gives us, I think, a lot of optimism. Next is sustainable agriculture. Our food systems here basically tell us that we're about a quarter of the world's carbon emissions come from our food systems. And today we know that the way we produce, consume, package, and sadly waste food is not sustainable, particularly in a world that's headed to 10 billion people. So we've got to figure out much more attractive ways and sustainable ways that we are going to farm our land, think about pesticide usage, be smarter with water, regenerative agriculture, and so on. And then lastly, the other big news was harmonization of disclosure. One of the things that is a sticking point for the investment community is the fact that we do not have a common set of information. So if you are going to have market scale, and I've been a 30-year capital markets banker, what you need if you're going to make an informed decision as an investor is to be able to have access to similar information. And unfortunately, today we're in a world where if you just try to compare two companies in the same industry on their sustainability metrics, you do not have apples to apples information. And there have been a proliferation of very, very well-meaning and actually reasonably effective initiatives of organizations trying to create those sorts of common sets of disclosures, but you had different initiatives proliferating around the world. And what we really need is harmony, because this is a global world. The markets are a global phenomenon. And so the IFRS is trying to harness and bring together the Sustainability Accounting Standards Board, the Climate Disclosure Standards Board, GRI, and others under one umbrella. And this would be tantamount to creating a whole new accounting system, but for sustainability. Now, that is gonna be hard. I don't underestimate the challenge underneath that. But the fact that there's this intent and will leaves us, again, hopeful. And it's probably years away, but this is the direction of travel. And I think this is exactly what the market's calling for, but it's also what our regulators are calling for, is this harmony of information. So those are the key points from COP. If we move to the next slide. Well, I thought I would then move to some of the trends that we're seeing in the market, just to give you a little bit of the backdrop why we see this sort of enthusiasm and the growth in the sustainable finance market continuing. And I really do think it will continue on this upward accelerating curve. Number one on the upper part of this box here, or bubble, is regulation. There are regulators all over the world that certainly feel the urgency of climate change as well as the social topics. And there is increasing regulation trying to intervene and either set standards or create best practice or force disclosure. All of the above is happening. So just in 2020, we had 120 new pieces of policy legislation around the sustainable finance arena. So the good news is that there's all that enthusiasm. The slightly less good news is that if you're a practitioner in this space, we're not necessarily having harmony across regulation. The EU has shown leadership with something called the SFDR, the Sustainable Finance Directive, which came into place in March of last year, which says to organizations such as ourselves, if you operate in any way, if you touch the EU, you don't have to be resident in the EU, but if you touch the EU with any sorts of financial instruments, then you're under the regulations of SFDR. And what it requires you to do is to categorize your sustainable investments along a spectrum and be very precise with how you're categorizing, and then be very transparent with your investors as to why you called something sustainable or impact under these definitions, which are called, they're under various articles. And so with that legislation, it was a very big attempt to try to get the finance community to have some sort of consistency and coherency. And what we do hope is that other regulators around the world will draft underneath the EU and hopefully have sort of one overarching set of regulation rather than a whole bunch of disparate interventions. So we shall see, but that's what we're trying to drive for as an industry. The other thing that we're certainly seeing is an enormous amount of engagement. I've been in the markets, as we say, for 30 some odd years. And I grew up in a world where we had shareholder activism, and typical activists were companies that would come, or investors that would come into companies and they would try to break them up for financial gain, try to bleed out efficiencies. This is a different kind of shareholder activism where you see coalitions of investors banding together in very large size, going into companies around sustainability agendas. So of course, we've seen the activity around the oil and gas sector, the Exxon example where you had shareholder activism put two NGOs on the board and they are pushing for change, but it's just not the high carbon emitters. What you see is they're going after all sorts of sustainability agendas. And that is driving real response. If you are a corporate CEO or a board and you have a coalition of 30 trillion of activist dollars saying they don't like your climate story, you're going to have to listen to them. And if you don't, it'll end up in a shareholder resolution in any case. So that's a new phenomenon, and that's increasing in a very material way. We also see the asset management industry say that they increasingly view sustainable investing as just the baseline. And in asset manager after asset manager running huge pools of capital, they're migrating very quickly their AUM to be sustainability as a baseline. And then I can't forget your generation. All of you are really driving this, whether you are creating change by virtue of the power of your consumer dollar because you're influencing companies by your purchasing habits or the demands that you ask of them, or as you begin to grow your wealth and inherit wealth, and I see this every single day when I'm interacting with our private clients in particular, my next gens of our wealth clients are saying, when I get the money or when I get my family company or when I grow my own wealth, I'm going to do things differently. And at the top of my agenda and what will drive my investment behavior is this desire to create a better world for myself, and particularly around the climate agenda. So for all these dynamics, we do not see any of this abating. So for those of you who are thinking about sustainability as a future career option, I always say go where the growth is. And this is one of the major places, if not the only place in financial services where you see this kind of quantum of organic growth. And this is not going to go away. This is going to be a decade, couple decades phenomenon. So if we move to the next slide. A little bit more in terms of just market dynamics and size. The market investment gap, as we call it, in terms of just green infrastructure alone, is calculated to be about $90 trillion. So this is the need to create waste infrastructure and green energy infrastructure and so on. But what's interesting for me is that when I started into this field back in 2017, I was constantly trying to have to make the returns case. Many of the constituencies that I was interacting with, whether it was investors or corporates or even our own shareholders or my peers, my employee peers, they were always saying, oh, isn't the sustainability thing come at a concession to returns? No. What we're really saying is, if you are solving a necessary problem, particularly one that's existential like climate change, by definition, value creation is there. So the sort of conventional thinking now is $1 invested into green and sustainable infrastructure yields at least 4 in benefits. So we've seen this explosion of sustainable investing. I think these numbers probably undersell the real size of the market, but the one trade organization that most people look to says it's about a $35 trillion industry and a growth rate of 100% over a 4-year CAGR. Also indicative would be the capital markets. So just the ESG or green bond market and social bond market, you can see on this upper right, absolutely exploded. It's going to double this year from last year. And new phenomenon, which are really interesting in terms of financial innovation, is happening. There was no such thing as a social bond just 2 years ago. And look here, that dark blue part of this bar in 2021, it's nearly a $200 billion market now from pretty much nowhere. And then up on the upper right, you see a slightly lighter blue slice, which is SLB, which is sustainability linked bonds, We also have sustainability linked loans, where an issuer will raise capital in the market and say that they will invest the capital according to a set of KPIs. And if they don't meet those KPIs, they're prepared to suffer a penalty in their cost of capital. Or the inverse is true, which is if they meet KPIs, another version of it is they get a step down in their coupon. And the market is loving that because they basically say you're putting your money where your mouth is. And they really like that direct linkage between where the dollar is invested and achieving certain outcomes. So watch that space. That's a new financial sort of piece of the market or slice of the market that is growing exponentially. And then we talk about the asset managers basically just saying, again, their money is moving rapidly into sustainability as an absolute baseline or just base good hygiene. If we move to the next slide. I also thought it was worthwhile thinking about global phenomena, because when you sit in either Europe or North America, you're very, very attuned to what you see in the news or what is really driving, I guess, the high carbon emitting spaces in your geography. And in North America, what we see in terms of the activist focus, it will be Arctic oil and gas exploration. It'll be fracking. Those are topics that are hot on the activist agenda in North America. But if we move to an area like Asia, where they've got their focus will be on palm oil and deforestation to service palm oil activity, which is pretty much in every consumer product that we use today, right? Whether it's cosmetics, whether it's your food system. And unfortunately, the way palm oil is farmed is largely unsustainable. And it's often in smallholder farmers that are very hard to track. So if you are a well-meaning company like a Unilever, as an example, who is reputedly and well known to be out on the leading edge of the sustainability agenda, even if you ask an advanced company like that, if they could get to the very, very end of their supply chain to ensure that their palm oil that's going into their products is farmed sustainably, by and large today, they say it's very hard to do that. So that's a big topic of interest. And then it's not going to be a surprise to you that when you move down to Latin America, deforestation of the Amazon is one of the biggest topics, and thus you saw the pact at COP. So there are regional nuances here, and it's just worthwhile, depending on where you're from and where you might be focusing your energies and maybe your future careers, to be attuned to the fact that the world is not equal in terms of the climate equation and what needs to be done. Next slide. I thought I would also put forward to you what are the top CEO worry list items around this whole climate topic. So when we poll and I'm interacting with C-suites and the board, what comes up over and over again? Probably number one, because it hit the scene this year with some accusations around a fund manager in Europe, is this concept of greenwashing. Anytime you have a very, very hot market, and this is based on my experience of a long time in capital markets, when you have a dynamic growth without a maturation and a common set of standards and a common language, what you tend to find is, of course, this enthusiasm can invite bad actors, or maybe not bad actors, but people who over market the product's characteristics or just in general. And that's the concept of greenwashing. So regulators are all over this topic right now. Part of the regulation that came in with that SFDR that I was talking about was trying to get out the topic of, are people really adequately and appropriately marketing the green or sustainability credentials of their financial instruments? Or when they have marketing pitches, are they overselling? So what we're saying here is that this is very much a topic of regulatory intervention, but also of civil society and the media. You see, if you read FT Moral Money and some of these other progressive media publications, they're focusing very much on, is the communication, or is the financial instrument, or are the use of proceeds, or are the KPIs in a sustainability linked instrument really robust? And if they're not, the investment community is getting very, very sophisticated, and they will hold you to account. So it's a very, very big topic for us constantly, and we're having to prove to our regulators as well as our customers, that they're there, that we are really robust, and that we're going to do what we say we're going to do with those sustainability claims. Regulatory change, I touched on this already, but I think what's happening in the C-suite is it's happening so fast that corporate CEOs and boards just don't know where this is all coming, and they don't know how to respond to it. And it's not just in the financial services sector. So if a policymaker wakes up one day and says, I will ban petrol cars in the next 5 years, and you happen to be in the auto industry, that's a lightning rod shot into your core business. And that sort of thing is proliferating around the world. Credible climate strategies is a little bit around this greenwashing topic, but it's even deeper than that. So when companies come out and they commit to net zero, or they say, I'm going to reduce my carbon emissions by X or Y, there are many people now coming in and holding those companies to account, either because they don't think they're ambitious enough, or because they don't think there's substance underneath the pledges. And so this is a very big topic where constantly I'm advising companies about what is best in class practice and what's expected of them from their various stakeholders. Next topic is carbon offsetting. I'm going to go into that in a little bit more depth because I think it's really important as you think about and you learn about operationalizing net zero. But carbon offsetting is the place where you go when you can no longer reduce your carbon footprint through operational mechanisms. So there's always going to be, at least for the foreseeable future, an unabatable tail to your carbon emissions that you can't get rid of, just like we were saying with aviation, because there is no green solution. If you're a company, and by definition, it's going to be the case, whose employees fly, those are activities that can't get to zero carbon, not today. So you need to buy offsets in order to account against that if you're going to be on a net zero trajectory. And this is a market that is extremely confused right now. You have high quality carbon credits, you have low quality, and the bid-ask spread between low and high can be anywhere from $5 or Swiss francs to $20. And that doesn't even take into account new technologies such as carbon capture, which takes carbon out of the atmosphere and stores it underground. Those nascent companies today, because they're early stage, the cost to do that ranges somewhere between $100 to $1,000 a ton. And obviously, if you're purchasing those, that's a pretty big expense line for any company, as much as we want to see those technologies mature and grow. So the one thing that, though, I did want to also point out is, in my mind, what's missing. So if we are going to have a fighting chance of fighting climate change, we are going to also, it can't just be about CO2 emissions only. We have to think about biodiversity in our fragile ecosystems, because those ecosystems play a massive role in mitigating global warming. So if we look at our oceans, not only do they give us every second breath we take by giving us oxygen, they also sequester roughly a third of the world's carbon. And yet the oceans are in absolute peril now. You have acidification, you have general global warming, you have the dying of the overfished stocks, you have 500 dead zones in the ocean right now where no marine life can grow. And the 500 dead zones are each the size of the UK. So the oceans really are in a very difficult position. And if we don't rush to try to take care of them, the compounding effect of an unhealthy ocean on climate change is something that is very, very serious. And I don't think, well, in the sustainability ecosystem, the penny has dropped. In broader society, when we talk to CEOs, very few think or understand that biodiversity is a topic that they need to think about either as a risk matter or as an opportunity set for their business. So this is one of the things that we're spending a lot of time on, trying to get that awareness out there, but then work in harmony with climate scientists and academia to identify the big bang for your buck by industry. What are the handful of interventions that companies can do in every industry to help to protect biodiverse resources? And we're not there yet in terms of full agreement on what those interventions are, but there's an enormous amount of intellectual capital being invested in that topic in particular. So if we move to the next slide. Now I thought I would take you into a little bit more of a deeper dive into operationalizing net zero. So one of the things that is certainly my takeaway from being so long in the capital markets is that in order for markets to scale, they need to have a common set of standards. They need to have a market adopted mechanisms, and there needs to be a common language. And one of the biggest areas that we're facing right now of I'd say a confused market is in transition. So green is pretty clear, although there isn't one universal definition of green. And so if we're thinking just in particular about the bond markets, we have this almost nearly $1 trillion green bond market. And there it's very specific. If an issuer wants to raise capital invested in a green solution, that is very clear and very prescribed and very well understood. But transition is a place that is complicated. So in particular, the high carbon emitting industries don't have access to the green bond market today, except in very limited circumstances. If an oil company wants to raise money to specifically dedicate it to, say, buying a wind farm, that would qualify. But if you are an oil and gas company and you want to invest the CapEx into your corporate transition, that would not be allowed under the green bond market. So 2 years ago, I noticed the gap in the market because I was seeing this dynamic where the high carbon emitting issuers were whinging that they didn't have a dedicated pool of capital to invest into their transition. We saw the investor community saying, I want to finance the transition. And then we had regulators coming into banks like ours and saying, why aren't you, financing an acceleration of the corporate transition? Why we weren't doing that was because there were no ground rules, and there was a lot of nervousness and cynicism on what a transition really is or isn't. They were very afraid of greenwashing. So we set about working with the Climate Bond Initiative, which is the NGO or nonprofit that helps set the green bond principles to try to create and define what a credible transition actually looks like. So we came up with a set of principles. We were endorsed by Mark Carney and Mike Bloomberg, and we went out and solicited the input from peers across the industry and academics and science to say, what could a credible transition look like? And we said it has to be in line with a 1.5 degree trajectory. That's the goal. It has to be grounded in science. Offsets don't count. Except for the very hard to abate tail, but you can't just keep doing what you're doing and buy offsets and hope that that is a free pass for continuing to operate the way you did in the past. And you can't use the fact that it costs more to not do it. You have to spend the money, and so on. So anyhow, we set a series of principles. And slowly, the market is adopting that. And we're very hopeful that that will provide that kind of comfort level for the markets to feel like this is a very robust way of looking at a transition and holding companies to account, and then allowing the transition market to scale very much like the green bond market did. So to that end, if we move to the next slide, how do you think about a pathway to net zero? Excuse me. So just to define what that means, when you're committing to net zero as an organization, you have scope 1, scope 2, and scope 3. So scope 1 is probably the easiest in some respects, although easy is in quotes because nothing's easy, but it's your own operations. So it's your own real estate footprint, which is typically somewhat controllable. And that is I'd say most companies kind of have a handle on how to do that. And scope 2 are typically your supply chain. So who are you buying from? So is it your energy supplier? Are they green? And it's not just energy. People tend to think that's the only thing. It's all of your vendors. So if I am buying computing power from a tech company, a Microsoft, is Microsoft on a path or on a route toward net zero as well? Because what you don't want to do is have your company be on a net zero path, and then you start using suppliers that are going the other direction. You're cutting against your ambition. But again, those are reasonably within your control. But I'll tell you the hardest one for a bank and most companies is scope 3. And that's really your operations. And in the case of a bank, it's who we bank. So what we look at, and using this SBTI organization, it really speaks to our lending book. Who are we providing capital to? And of course, as a global bank, we're banking virtually every industry. So what we have to do is go in a very rigorous way and map the trajectories of all of our clients by industry. And this is an industry-driven phenomenon. So you typically will start at a cross-section of the highest carbon-emitting industries intersected with where your greatest exposure is as an organization. So we look at our loan book. So where does that intersection hit between highest carbon emitter plus our book? And then we come up with the most emissions that we're financing. So in our case, it was oil and gas and coal. as the first one, and we've mapped that trajectory. We're looking at every company that we have exposure to, and then we have to ask ourselves, are they on a credible transition to net zero? If they are, we can continue to do the same kind of business lending to them because they're on the same pathway. So we're all headed down that curve together. But if there's a company that says, don't care, we do say there are companies that are unaware and don't care. They say, you know what, all of this, I'm just going to keep doing business the way I have been. Those are very tough conversations as a lender that we're going to have as their loan rolls off, because if we then continue to lend to them, at the same point as with your supply chain, you're going to cut directly against your path to net zero. So we're going industry by industry in our organization, in transportation, shipping. As a private bank, many of our clients made their wealth in shipping and so on. But what my book looks like versus another bank's book will be different, although somewhat similar. And then you get to the unabatable tail, which I was talking about earlier. So that's the below the line number that you see, or the graph that you see here, the color in yellow and green. So for anything that we can't abate, we've got to purchase offsets. Today, 70% of the offset market is what's called carbon avoidance. So you're buying certificates for things that you don't do, which would avoid carbon. But what that's not doing, those certificates, they're not removing carbon out of the atmosphere. So what SBTI has said is that they've now given guidance to the financial services industry and others to say that those don't count. You actually have got to be buying carbon certificates or offsets from activities that take carbon out of the atmosphere. And there's only a handful of ways to do that. You've got tree planting, you've got a little bit of work in oceans, like planting mangroves and other things which create those healthy oceans, or you have these emergent technologies like direct air capture and storage. But those are so tiny today. The entire industry on DAX, as we call it, probably could handle only a couple thousand cars. So you can see very quickly where you're going to have a short squeeze in terms of supply and demand. So today, where we might be buying carbon offsets on the high quality side at 20 or maybe $50 a ton, if I'm committing to net zero and every bank's committing to net zero and all these corporates are committing to net zero, and we can't abate that tail, say, of our flights, we're going to have a real problem, because the price of buying these offsets is going to skyrocket. So these are the sorts of things that we're thinking about every day, and there are projections. There are many organizations that are projecting where carbon prices are going to be to buy those offsets, and they range from $200 a ton and up. And you can imagine, if I'm trying to then get hundreds of tons of carbon to be offset through these certificates, that's going to be a very costly line item on my P&L. So these are the sorts of things that we're all thinking about, and it's certainly, if you're interested in being a part of this industry, is well worth trying to be facile on. But this is why we really have to work on our operations more than anything. So you can sort of see what the curve looks like, or certainly what we hope it'll look like. We're committing to interim targets by 2030, and then ultimately you want to get to net zero. And there's probably still going to be some tail with carbon offsets. But that really, the hard graft has got to be, the work that we're talking about here on our financed emissions. So if we turn to the next slide, you could look at this in a very negative way, which is all the stuff we have to give up, which is the graph on the left-hand side. This is sort of how we look at it. We look at our carbon baseline, and then we say, how much do we have to reduce, or exit relationships in order to be able to get to our trajectories. But, I certainly believe that, and just as my opening quote said, if we view this as one of the biggest opportunities in history, if we can be financing our company's transition, that's an enormous opportunity set for an organization like ourselves. So as I am trying to embed this notion of the net zero program that I'm looking after into my businesses, and all of my bankers that cover different industries, I've said, don't view it as only me taking something away from you like your lending capital, but look at it as an opportunity for you to seize the market and move into places where you can be financing your companies that are in transition. So that's the other side of that coin. So if we move to the last slide, I just wanted to leave you with a little bit of a case of optimism. There's a question, is net zero truly possible? I wouldn't be in this business if I didn't get up every day and was hopeful. Otherwise, I'd probably jump off a building. But I am hopeful. At Credit Suisse, we kind of, our guiding light is what I call the sustainability triangle. So on the one leg, it's disrupt for progress. So I want to be financing all the disruptive technologies, whether it's EV or alternative food, some of the amazing companies that we're seeing that are creating real value as they really disrupt existing industries with technological or business model intervention. But we also have to focus on transition. So that's that big opportunity I was talking about. It's going to be trillions invested in our corporate migration to greener solution. And then finally, my third leg is protect the future. So it's conservation, it's that biodiversity that we're talking about. So if I get all three of these working in harmony, then I genuinely believe we can get to a net zero world. And, I do believe in the power of human ingenuity and will to get there. Another way of looking at this, away from Credit Suisse and my own activities, is an organization called the Energy Transitions Commission, which is a coalition of some amazing, great thinkers and NGOs and climate scientists and governments who've all done hugely, hugely good work in trying to map out in a really rigorous way, is it possible to get to net zero? And what they would tell you, a third has got to come from disruption, so that technological intervention. A third is going to come from process improvement, which I would also translate into transition, but it's fixing leaky pipes and making sure your lights turn off and you don't overheat or over air conditioning, little stuff. But the biggest third, and this is what I want to leave you with, is a reduction in consumption. This is your own individual choices every day as a consumer or as a citizen. That's the hardest piece because nobody wants to give something up. And this is the place where I think all of us are, individual power that becomes a collective has got to be a piece of the equation. So if there's anything that you can do away from your businesses where you might invest your future career, it's waking up every day and thinking about the choices, what you eat, what you buy, what packaging you use, how you waste. All of these things are a third of the way to get there to net zero. So hopefully that was helpful in terms of setting the scene back at a macro level. And I know the next sessions that follow are going to go back into more micro, but maybe that set a little bit of the scene and that case for optimism. So thanks everyone for listening.